Good evening, everyone. Thank you for joining us. We're just going to give it a minute or so while we wait for people to come through from the waiting room, and then we'll get started. Just give it another moment. Numbers seem to be levelling off. Okay, I think we've got most people through who are going to join us, so we will get started. So good evening, everyone. Thank you for joining us on our webinar this morning to give you an update on NHS pensions and the annual allowance, specifically for GP practitioners. So my name's Louise. I'm a partner with Larking, Gowen accountants specialising in the medical sector. I'm joined this evening by Lizzie, my fellow partner, and Simon, who is an independent financial advisor from Medical Financial Services. So we're going to talk through a bit of a very brief overview from what we see from an accountant's point of view and looking at it from tax purposes. And then Simon can give it from a financial advisor point of view. So we have a real good all-round session. You will be on mute throughout the whole webinar. So if you do have any questions, you should have a questions box. So please do pop any questions in the box, and we'll have some time at the end for a Q&A session. If for any reason we don't get through all of the questions, we will have them on our system. So we will come back to you personally with any questions that we raise, but otherwise we will get started. So just a brief agenda. So we're going to do a very brief recap of annual allowance and the tapering. It's been around for a little while, so hopefully we all know what it's about. And then we're really focusing on what the effects of the currently high inflation rates are doing to the annual allowance and why it's a problem with the rates increasing as they are. And then we're going to talk around what options you have if you are subject to a tax charge. So moving through, brief recap of the annual allowance. What is it? So every individual has a £40,000 limit. That is their pension input amount. So for GP partners, this is not based on your pension contributions. It is based on the growth in your pension benefits. They're not straightforward calculations, and it is linked to pensionable pay and historic pension benefits that have built up to date. If your growth is more than your allowance, then you will have a tax charge on the excess at your marginal rate. There were some changes from April 2020 onwards, which have helped the situation around the tapering of the annual allowance. So nowadays, if your taxable income is more than £200,000 per year, and that's from all sources, so not just NHS sources. So if you have any rental properties that you earn profits, if you have any dividends from a limited company, investments, bank interest, all of that income is pooled. And if it is more than £200,000, you are at risk of being tapered. Now, that limit used to be 110,000, so there are less people now being tapered, but the minimum has gone from 10,000 down to a minimum of 4,000. So there is a lower bottom line, but less people being caught. So if you do have excess growth, you can look back 3 years and see if you have any unused allowances to bring forward. We're seeing less and less of those due to some periods of high growth, sort of around 17, 18, 19, 20, and potentially in 2021. So there are less and less available allowances to bring forward from the prior 3 years, but it's still an option. And if you do happen to have a tax charge, needs to be recorded on your tax return, and you can choose to pay the tax personally along with your normal self-assessment payment in the January, or you still have the option to ask the pension scheme to pay this for you and complete a scheme pays election. So hopefully all of that is prior knowledge. So just moving through to the next slide. So where are we where issues can arise? Increasing profits. So for GPs, your pension benefits are linked to your pensionable pay in both the 95 scheme, the 2008 scheme, or the 2015 scheme. So if your profits are rising, your pension benefits will be growing at a quicker rate, and therefore the associated pension inputs will also grow at a quicker rate. Increasing inflation. Your pension benefits are uplifted every year by inflation, and if you are a contributing member, you also get an extra 1.5% uplift on top of those benefits. So if we're in a period of increasing inflation, as we are, benefits are going to grow at a quicker rate. If you have outside earnings, again, this can cause a problem due to the tapering of the annual allowance. So if you have, like I say, high dividends or rental profits and it tips you over that £200,000 limit, you are more likely to have an annual allowance problem. If you have an added years contract, the purpose of these was to build up pension benefits where you might not have got the maximum years service within the 1995 scheme. So you were able to purchase additional years, and so therefore your benefits are increasing at a quicker rate, and so it's going to lead to increased pension growth. And finally, if you contribute any or make any contributions to a private pension, when we look at your 40,000 limit or whatever your personal limit might be if you're tapered, we have to take into account all pension pots where you are contributing. So if you have an NHS pension, we would calculate your pension inputs, and we would need to add in any contributions to a private pension. So again, if you're that can add to a problem or may just tip you over whatever your annual allowance limit might be. So just moving on a slide, what we're going to focus on today is the increasing inflation rates. So as I'm sure you're all aware, as at May 2022, we're at 9.1% inflation. It's been quite a few years since we've seen figures anywhere like this. So this hasn't been an issue, certainly not since annual allowance became a problem. So why is inflation an issue and how does it impact growth? So each year your benefits are uplifted by inflation using the value at the September within the relevant year. So for 2020/21, we used September 20, which was 0.5%. The following September went up to 3.1. So we're only at May and we're already at 9.1%. And who knows where we're going to go from here. And as I said earlier, contributing members will also receive an additional 1.5% on top. So we could be looking at a 10.6% growth without adding in any extra pensionable pay, which is great because, you know, it is improving your pension benefits, but not so great when we see how we work through some figures. So if the inflation rate is rising, as it currently is, benefits are growing at an increased rate compared with the periods of lower or falling inflation. When we calculate your pension inputs, so the figure we compare to your allowance, you do also get an uplift for inflation for the opening year position. So we take whatever it was at the end of last year, uplift it by inflation and compare it to the closing balance. And that's, broadly speaking, your pension input. Now, the opening position is uplifted by the prior year inflationary rate. It's a bit of a quirk in the system. So if we look at 22-23, the current year that we are in, your benefits for this year will be uplifted by, at the moment, 10.6% if you are a contributing member. Your opening position is only going to be uplifted by 3.1. So you don't get the extra 1.5% when looking at the opening position. So you can see that there's a 7.5% difference between that opening inflation and the closing inflation. And that's where the problem comes from. So in periods of rising inflation, the opening year uplift will be at a lower rate than the in-year uplift, so we get increased growth. In falling inflation, the opening year uplift will be higher than the in-year uplift, which can lead to reduced growth. So let's put that into numbers. We like numbers, makes us more comfortable. So just some broad figures. Now, for this, we've assumed that the whole host of problems from McLeod, which again, hopefully you're all aware of, but effectively the pension positions have been reworked. So as at March 2022, this member in the 1995 scheme, all of their benefits up until March 2022 have been recalculated, and there's no benefits in the 2015 scheme because they've all now been shifted back into the 1995 scheme. So this member for the current year, 22-23, has pensionable pay of 150,000, which is not uncommon, especially where we've seen profits increase with COVID. And as at March 2022, they had built up pension benefits of just over £30,000. So without even taking into account their pensionable pay, just using the inflation, the pension will go up by £1,100, can't do my maths, £3,000, just over £3,000. So from 30,000 up to 33,300. So that is just with the inflationary uplift. That doesn't even take into account any pensionable pay. So working through the numbers, that generates a pension input of £42,473 in the 95 scheme. So bearing in mind, their contributions aren't going into the 95 scheme, they're going into the 2015 scheme for this year. So you've got pension growth of over 40,000 just from inflation. So you've already breached your limit. Plus we've got then £49,000 of growth in the 2015 scheme as a result of the 150,000 pensionable pay and an inflationary uplift. So bottom line, £91,500 of growth for this GP in 22-23. Now, assuming they have a full £40,000 allowance and they don't have any unused brought forward, they're going to have excess growth of £51,500, probably taxable, majority of this at 45%, judging by their pay. So that's a tax charge of £23,213. So what this really demonstrates is the focus on that 95 scheme benefits. No pensionable pay going into that scheme, that's purely the inflationary uplift. Moving through to the next slide, just to take this forward a year to show how inflation also it impacts the figures. So if inflation stayed at 9% for next September in September 23, again, the 95 benefits will increase by 10.5%. But because the opening position is also uplifted by 9%, the pension inputs in the 95 scheme are now only £9,500. So we've gone from 42 to 9.5 just by using different inflation rates. 2015 scheme, because it's calculated a slightly different way, has a very similar growth. So you've still got overall growth of near on 60,000. So still going to be a tax charge of 8,600. But as you can see, if inflation starts to level out, the tax charge reduces. If we flip it and say, well, what if inflation drops back down to 3%? Your 1995 benefits are only going up by 4.5%. But because the opening position is going to go up by the 9% that we had in 22-23, you've actually got no growth in the 95 scheme. And the 2015 scheme growth drops down a bit because we've got a lower inflation rate. So again, probably still a tax charge, but this time just shy of £2,000. So we can see here in rising inflation, £23,000 tax charge, levelling off 8,600, dropping down 2,000. Now, if inflation dropped to 3%, the 1995 scheme would actually get negative growth of 28,500. Now, that doesn't mean your pension is going to go down. That can't happen. It is just how the growth figures are worked out. But unfortunately, legislation doesn't allow this to be set against the 2015 scheme. It's just treated as nil. We can't carry it back. We can't carry it forward. It's lost. Now, there was a letter that AISMA, so Association of Independent Specialist Medical Accountants, which Larking and Gowen are part of, we wrote to the Treasury to point out some of these issues around different inflation rates, negative growth. You know, can they change legislation to do something with it? Sent a very polite response, basically saying no, we're not going to change anything. Now, that was yesterday's health secretary. Today's health secretary might have a different story, but as it stands, there is nothing you can do about having this negative growth, unfortunately. Next slide, please. So you may think, well, I'm only part-time. I've not had a problem before. It's not going to affect me now. Unfortunately, that is no longer the case. So just to rerun some of the scenarios, but with a GP who's got £75,000 benefits, we're starting with the same position, 30,000 pension benefits built up. So because they have a similar amount of pension benefits, so this could be someone who's been in the scheme for a long time, starting to wind down. So they've got a nice pension there to begin with. So they've still got that £42,500 of growth in the 95 scheme because it's based on the benefits that have already built up to that date. Yes, they've got slightly lower pension inputs in the 2015 scheme because their pay is lower, but you can see there we've still got £67,000 of growth, so a tax charge on the 27,000. Now, where it is different is that part-time, lower earning new GPs are probably more likely to have some unused allowances brought forward because you might not have had the issue in early years than full-time or higher earning GPs. So it might not be doom and gloom, but it's certainly something to think about. Speak to us, speak to Simon, because we can't guarantee it at the moment that you're going to be okay. So what happens if you do have a tax charge? I'll cover this very briefly at the beginning. You can pay it personally via your tax return and pay it over in January. It does also affect your payments in July. So if you've got a tax charge, that also impacts the payments on account. Now, if you know you don't have a tax charge for the future year, you could look to reduce those payments on account. Option 2 is you do a scheme pays election. So you ask the pension scheme to pay the tax charge to HMRC. So effectively a loan, they pay it on your behalf. It's an irrevocable election. So if you ask them to do it for any given year, you can't change your mind for that year. You can change the amount, but you can't say, well, actually, I'm going to pay it personally. Future years, you still have the choice. It's not once you've done it once, you have to do it for every year, but it's irrevocable for that given year. NHS pensions will charge interest until you draw your pension benefits. So it's around 2.4%, and Simon's going to cover off what that looks like in real terms. And your benefits will permanently be reduced on retirement to recoup the debt. So they spread it over a period of years, depending on when or what age you are when you retire. It can be a good thing because lifetime allowance is, and therefore income tax on your pension, will be calculated on a reduced pension benefit. So potentially you've got lifetime allowance issues, the scheme pays election can work in your favour. So that's why I would always recommend getting financial advice when deciding what's best for you. Unfortunately, there are no compensation schemes. This again was something we raised in the letter. 1920 was a one-off. It's back the personal liability of the individual to pick up. Okay, so I am now going to hand over to Lizzie, who's going to talk through some of the options in a bit more detail and what it all means.
Thanks, Louise. I've just been looking at the chat while Louise was speaking, and somebody's raised the questions they didn't understand in 23-24 if inflation had stayed at 9%, so increase in pension benefits was still based on 10.5%, why in the 95 scheme the pension inputs fell down to just 9.5%. It's because HMRC allow you, when working out the pension inputs, to uplift it based on the CPI from the year before. So it doesn't mean your pension benefits have grown by any less. It just means the way HMRC allow you to do the calculation is that if you've got 2 years of stable inflation, is better than a year when you've got a rising inflation. I appreciate it's complicated, but I just thought I'd try and put that in a slightly different way to make sure that that was better understood. As Louise has said, if you face a tax charge, it's because your pension has grown, mainly perhaps because of inflation. So you're effectively paying tax now on having pension savings, a bigger pension on retirement. And obviously you can choose to pay that tax yourself or have it coming off that pension at retirement. Doesn't come off in one go under a scheme pay election. So say the pension tax charge is 23,000, doesn't mean your pension is £23,000 less per annum. It's divided by a factor depending when you draw the pension and permanently reduced over the life of you drawing it. So it's worth looking at the scheme pay recovery fact sheets, which are on NHS Pensions website, to see how that all works out. Obviously then, what the question we often get asked is, what is the position if I opt out of the scheme, or I do a bit of hokey cokey and I opt in and opt out? If you are opted out for an entire pension scheme year, and the pension scheme year runs from the 1st of April to the 31st of March, so you're not in the pension for the whole 12 months, then you cannot have an annual allowance pension tax charge. Your pension will still increase, albeit only for an inflationary factor, not the dynamisation plus 1.5% necessarily, and you won't be pensioning any pay, so there can be no pension tax charge. But of course, few people opt out as at the 31st of March and then leave it an entire year, and there's probably several of you on the presentation tonight who are thinking you might opt out, say, at the end of July. So this example I've got on the screen is looking at that, so starting from the 1st of August being opted out. What you must remember is when you're opting out, it means you are pensioning less income. So in turn, you will have less pension in retirement, your pension growth will be less, so you will have a lower pension tax charge. So working on from Louise's example here, somebody who's been in the pension scheme for 4 months, earning 150 grand, though over the entire year, would be pro rata pensioning just 50,000 of that. They've still got their pension pot in the 95 scheme, that doesn't go anywhere. But the inflation that would then be applied based on September 22 inflation is also prorated up to the point they opted out. So 4/12 of the 10.5% in this example, 3.5%. So automatically that gives a much lower growth in the 1995 scheme, because we were able to uplift the opening position when working out the pension inputs by 3.1%. The pension has gone up by 3.5%, so very small growth in the 95 scheme. And the 2015 scheme growth is less as well, because you're only pensioning 50,000 of pensionable pay. So this would give pension inputs of 17,621. Remember, this pension input figure is an arbitrary figure that the pensions agency work out for you based on HMRC legislation. What HMRC legislation is trying to give to you is saying, if your pension grew by this much, this is how much we think in the open market, 17,621, you would have to pay in pension contributions to get that pension growth. Because people who aren't in NHS pension schemes or defined benefit schemes, in personal pension schemes, they pay their pension contributions into a personal pension, into a pot, which is their money, and it's what they pay in that's then counted against the 40,000. That's not the same in your scheme. It's defined benefit. It's a benefit based on a defined earnings and inflation. So there's a different way to calculate it, which I understand is complicated. So in this example, this person who's opted out after 4 months, they are below, therefore, the 40,000 annual allowance. But their taxable pay is going to be higher, which I'll show you in a moment. And we have to watch this £200,000 threshold taxable income, because they may not then have a 40,000 annual allowance to compare to this lower pension input. So side by side here, I've got somebody who hasn't opted out and someone who has opted out. So they've both got, it's the same person, obviously, practice income of 190,000, some outside earnings, some rental income, pension contributions. So if they don't opt out, they're paying pension contributions for the whole year. That reduces their taxable income. Brilliant, it reduces it to below 200,000. They've got a 40,000 annual allowance to compare to their pension inputs. By opting out, they've only paid pension contributions for 4 months. They're above 200,000. So there's another calculation that then works out if they've got a 40,000 annual allowance, or it's tapered right down to 4,000 annual allowance, which then when compared to the 17,000 for opting out, doesn't really solve any issues. But this is where the individual could potentially say, well, actually, maybe my outside income I won't do, or I'll put it in a limited company and shelter it from my income tax computation, or I'll move the rental income to my spouse. Please do take advice before you do any of those things, because you can't just move rental income, say, to a child. And even moving it to a spouse has some hoops to jump through. But ultimately, this individual, even though they've opted out, even if they retain enough annual allowance to cover their reduced annual allowance excess or pension input figure, they've got more taxable income. So they're going to pay more tax. But obviously, then they're going to avoid the annual allowance tax charge. So that nets off for them as a tax saving, working back on the examples we've been building on, about a tax saving of £12,000. They'll also get their pension contributions that they haven't paid in. They'll be able to take those as additional drawings. That's where the extra tax charge comes in. But the other side of the coin is that they're not pensioning all of their pensionable pay. They're pensioning 50,000 instead of 100,000. And ignoring dynamisation, that's broadly a loss of annual pension benefit at retirement. So this is an amount every year that they would take in retirement of £1,851 by not pensioning that 100 grand of income. So you've got to weigh up both sides. I'm afraid that the position is a little bit more complicated for those with a non-31st March year end. So if you have 30th of April, 30th of June, anything that's other than the 31st of March, you do need to just check what opting out means for you, because you are pensioning your pay in arrears. So if you've got an April 22 year end, 30th of April, 11 months behind the accounting, the tax year end and pension year end. So normally in 22-23, you would be pensioning 12 months of pensionable pay to the 30th of April 22. So if you opted out on the 31st of July, that is still a date, July 22, that's in the 22-23 tax year. So we've got to add on to those 12 months to 30th of April, another 3 months to the 1st of August. But then we can take off these pension overlap profits, which replicate 11 months of pensionable pay when probably you join the practice. They aren't indexed. You may have been part-time when you joined and you're now full-time. You may have been lower earning and you're now higher earning. So those overlap profits of 11 months don't reflect 11 months of current profits, which means by opting out 4 months in the year, those 4 months could be much higher than what you expect 4 months of profits to be. So we said in the previous example, 4 months would be 50,000 if you're earning 150,000. But if your overlap was just 100,000, those pensionable profits are 87.5. So we've got more pensionable income going into that annual allowance calculation. The other slightly bad news on this is that PCSE will be deducting pension contributions every month for you based on an estimate that you submitted, probably an estimate of 150,000 in this example. So they'll have only collected 4 months based on that, which won't cover the 87.5 if you opted out at the 31st of July. So you're going to probably have a pension shortfall to pay potentially by opting out, depending on your own circumstances. And you may have higher pensionable pay than you expect, and therefore more likely to have a pension tax charge than if you had a March year end. Just in that year of opting out, it's not going to be a recurrent problem. So then often people say to me, oh, I should reduce my sessions. I'll reduce my sessions and that will work. Definitely won't work with a non-March year end, or probably won't, because if this example, you've got a 30th of April year end, and as I said, 30th of April 22 would fall in the 22-23 tax and pension scheme year. That year end is already passed. You now can't influence that year end by reducing your sessions at the practice. You may be able to reduce earnings outside of the practice that you do on a 31st of March year end. It won't affect the growth in your pension that Louise worked out right at the start, but it might have an impact if you're going to be close to the 200,000 of taxable pay, which is where it can start to get really penal. The reduction in sessions really came about when this threshold income was 110,000. So what I mean by that is, going back prior to April 2020, you had taxable income above 110,000, that's when the tapering reduced and made it sometimes sensible to drop a session to get out of it. We're not in that situation so much now. Quite a lot of people are going to be below the 200,000 taxable pay, still retaining a 40,000 annual allowance, but it's the inflation that is growing the pension input. So reducing sessions is not going to get you more allowance to set against that pension input figure. And as we've seen in those examples that Louise showed, even somebody who's low earning, who have already reduced their sessions, could still have a excess to pay, depending on how big their pot that they've already built up of pension benefits is, which this inflation is going to be applied to. So yeah, I think the key message we are probably trying to ram home is, if you're marginal on that 200,000, you know, is there anything you can do to retain the 40,000, because it does get quite a lot penal, more you know, worse if you're over that. So if you wanted to opt out of the scheme, and there are other pension benefits you will lose by opting out of the scheme, and obviously Simon's going to talk about those. What does it mean about rejoining? Well, don't rejoin by the 31st of March, because if you opted out in August and joined 1st of February 2023, that dynamisation is going to happen for the whole year. Even though you opted out, they're going to look back and go, well, you're in the scheme at the start of the year, you're in the scheme at the end of the year, you're going to get that 10.5% dynamisation, which is the problem, the inflationary uplift. Yes, you'll have slightly less pensionable pay for those few months you're out, but it's probably not going to give you the result you had hoped for. But what if you then rejoin the following year? What does that mean? Well, if you opt back in, I believe it's within 5 years, if you opt back in, the dynamisation that stopped when you opted out will be rolled up in the year that you opt back in. So, for example, this individual who opts back in the following year, you'll just have to take my word on the numbers, and I have assumed inflation has fallen, which may or may not be the case. Although they've got, you know, less pensionable pay and inflation has fallen, we get that 9 plus 9%, 10.5%, whatever it's going to be, inflation backdated. We've just kicked the can down the road on the inflationary factor into another tax year. Now, that may be good. It may be more palatable to kick it down. We still may have, because if inflation has fallen, then you're kind of offsetting some of that negative growth that otherwise you wouldn't be able to, that again Louise explained, and you may have some unused allowance from the year you opted out to mop up for this year. You just got to keep an eye on inflation. And what is extremely difficult for you as GP practitioners is the predictions. You know, we're having to predict ahead, not only on what inflation may be if we're doing such calculations, but also we don't know what you're going to have earned in that year until we've done the accounts, which is after the year end. So you can't retrospectively change your mind and go, well, actually, if I'd known I was going to earn this much, I would have opted out 4 months ago. Which comes us on to the practical considerations with regarding to opting out. First of all, though, let me talk about the scheme pay election. So the scheme pay elections that are one solution to pick up the pension tax charges have to be submitted in the July following the end of that pension scheme year. So we'd be submitting scheme pay elections for 22-23 by July 2024. Now you may think, oh, then that's fine, but they will be estimated. We actually want to be submitting those scheme pay elections well before the 31st of July, because the tax is probably going to be due earlier. And we would rather the NHS pension scheme paid the tax when it's due, rather than there be any potential interest repercussions that HMRC may change. So you want to submit them earlier. It's going to have to be estimated, because we will work out our figures, but the Pensions Agency are ultimately the only ones who can work out the pension input figures. And with all the changes in McLeod, they are going to have to obviously go back and change some of the pension input figures from previous year, which potentially will affect the future as well. So they'll go in as estimated before the deadline and then be updated later. If you're thinking of opting out, then the process is fairly straightforward. There's a form called an SD 502 form, which is sent to PCSE. You can upload it onto their PCSE inquiry portal. PCSE will have 40 days to process that. Now, if you submit it tomorrow and they don't process it till the end of August, but you signed and dated it tomorrow, then it would be applied from the end of the month. So you would opt out from the 1st of August. They may carry on taking pension contributions until they process it, but they will refund those and confirm to you the date that you had opted out, which is the date submission of signed. But they won't retrospectively do it. You can't now opt out as at the 30th of June. Your next date is the end of July. They seem to only do month ends. Opting in, again, is the same, advising PCSE. Again, there might be delays in restarting your pension contributions. You just need to keep an eye on that. What we don't want them to do is to forget to restart or forget to process the form, which means they don't collect the pension contributions, because we can only claim tax relief on those pension contributions when they're paid. So if you went back in the scheme in January and they didn't take the contributions that you owed for January, February, March till April, it's in another tax year before we can claim those contributions against tax relief, which may affect the level of your taxable income, which may then affect how much annual allowance you're allowed, and the tapering. So that was a sort of quick canter through from Louise and I of how it's going to work, why the inflation is such a worry, why you've had those emails from the BMA. Yes, there's no magic answer. It's stay in and pay the charge, stay in and do scheme, pay election, opt out, bit of hokey cokey. So we're now going to hand over to our guest speaker, Simon, who will hopefully come on the screen now. Hello, Simon.
Hi there.
And I will try and move your slides for you quickly.
Thank you very much. I'm not sure about being a guest speaker, but what we're going to do is have a brief recap of the 2015 pension scheme and just look at the benefits the scheme actually provides, because I meet many clients who, with all the issues that we'll talk about in a moment regarding membership of the NHS, including the annual allowance, do have concerns as to whether they should still be a member of the pension scheme. So we'll cover that off. I've got a couple of estimations, some examples of the actual cost of the scheme pays if you choose to use that, what it actually means to pension benefits at the point of retirement. We're going to briefly cover the lifetime allowance and, importantly, what the scheme pays election does to any lifetime allowance charges you subsequently have. If the election is to leave the scheme either for a period of time or entirely with no intention of rejoining, what that actually means. And we're then going to look very briefly at some of the other options that would be available, both in what you should be considering replacing privately in the form of protections and pensions, and some of the things that could be done with surplus capital if you do leave the scheme with those extra drawings. Now, the next slide talks briefly about the 2015 pension scheme. Everybody will have transitioned into the new scheme with effect from the 1st of April. So everything you have to date with the McLeod judgment, etc., most of you will be, I'm sure, in the 1995 scheme. Those benefits are parked, and everything you're accruing now is in the 2015 scheme. So the basis of the scheme is broadly the same. It's still a career averaged revalued earnings scheme. That means that each year's earnings is aggregated together with your previous year's earnings, and you eventually end up with a pension based upon the total pot you've accumulated during your working life. You accrue a pension on a 54th basis, or if you prefer a percentage, 1.85% per annum of your superannual earnings ends up as your pension in year one. So £100,000 worth of pensionable earnings gives you a pension based on that individual year, ignoring the dynamisation of previous earnings, of £1,850. Now, notionally, that makes the scheme better than the 1995 scheme, which had an accrual rate of 1.4%. However, there are some considerations. Firstly, there is no automatic tax-free cash lump sum on the 2015 scheme, which there was in the previous scheme. So you can take a cash-free lump sum, but to do so, you need to reduce the pension you would receive. And on a like-for-like basis, the two schemes accrue benefits broadly in the same fashion. The big difference is the retirement age. 1995 scheme benefits, you would retire at 60. That's the usual pension age where you can draw benefits without any penalty. The 2015 scheme is linked to state pension. So that currently is retirement at 65. That's increasing to 67 for anyone due to retire from 2028 onwards. It's increasing to 68 from 2044, and there is currently consultation to bring that 68 date forward to 2039. And there is a broad expectation that eventually state pensions will begin to be paid from probably age 70. There's no requirement for the scheme to make changes to facilitate that. It's written within the terms of the scheme that benefits will be accrued, you can receive benefits without any penalty in line with state pension. Death in service benefits, these are exactly the same with all the schemes. So if you die whilst in the service of the NHS, or whilst a member of the NHS pension scheme, there's twice your average superannuable income payable as a one-off lump sum. That would normally go to a spouse. If you don't have a spouse, you should complete what's called a DB2 election saying who you'd like to have that sum. The potential for an ill health retirement pension. On long-term incapacity, most partnerships, the agreement states 12 months full pay. At the end of 12 months, the partnership agreement is dissolved and you're no longer a part of it. At that point in time, you can apply for either a Tier 1 or a Tier 2 ill health retirement pension. Tier 1 would be payable if you are unable to undertake your ordinary occupation. So if you can't work as a GP, that means that whatever pension benefits you'd accrued to date would be payable at the point the Tier 1 was accepted without any early retirement penalties. Tier 2 ill health retirement is if you cannot undertake any paid occupation of like duration. So you can't be a GP, you can't work in Tesco's, you're unable to undertake any form of paid occupation. In that instance, you'd receive all of the pension you've accrued to date, plus 50% of the pension that you would notionally accrue between the date of the ill health and your normal retirement age, which will be 67, 68. Now, there's no guarantee that you would receive an ill health pension. Many issues that GPs face with regard to ill health wouldn't trigger off an ill health pension. The premise is that the condition you have must be permanent. So if there's an expectation that you will recover, then ill health won't be paid, which is why it's important to have, alongside that, things like income protection policies. Finally, there is the spouse and dependents benefits. So in the event of your death, if you have a spouse, they'd receive a pension of 1/3 of your notional Tier 2 pension. Up to 2 children would receive an additional sum each. So if you've got a spouse and 2 children, then 2/3 of your ill health pension would be payable. It's payable to the children until they reach age 23. It's payable to your spouse through life. If we can move on to the next slide, what I've done here is tried to put a bit of flesh on the bones of what a scheme pays election actually means. Now, as Louise said earlier, what we're asking from a scheme pays election is for the pension scheme to pay that part of your tax liability caused by the pension to HMRC instead of you paying it directly. It's treated by the scheme as a loan. As with most loans, there's interest chargeable. Interest charged currently is at CPI plus 2.4%. Now, it's always CPI, but the plus figure has changed. At one point, it was plus 3.1%. That's actually reduced slightly. Interest starts to be charged from 6 months after the scheme pays election cutoff point. Now, this is quite important for 22-23 because some of the scheme pays charges look to be really quite high, or some of the annual allowance charges look to be quite high, which means many people, I think, will be using scheme pays elections this year when historically they may not have done. Now, the election must be made, as Lizzie said, by the 31st of July 2024. Interest begins to be charged from the 1st of January 2025, so 6 months after that cutoff date. So The scheme pays election, so the annual allowance charge is principally caused by inflation being as high as it is at the moment. Whilst when you actually start paying interest, hopefully CPI will have reduced to more normal levels. So the charge you have moving forward, hopefully, won't be the 9–10% that is causing the issues at the moment. At retirement, your pension is reduced by a factor to recoup the total cost of the scheme pays. So that's the amount that the scheme is paid HMRC plus the interest that's accrued. There's a few factors which I'm going to be talking about. As with some of what we talk about, they're slightly arbitrary figures that are provided to us, that there is reasoning behind them all. The scheme actuaries work very hard to put these together, but I won't go into that this evening. It is fair to say that scheme pays is more expensive the younger you are. And as Louis said earlier, once the election is made, it cannot be changed. So we're going to move on to a couple of examples. This picks up from the first example that Louise used earlier with a member with a total annual allowance charge of just over £23,000. Now that is split, the liability is split against which part of the scheme caused the issue. So in this instance, a little over 10,500 of that scheme pays is caused by membership of the 1995 scheme and just over 12.5 by membership of the 2015 scheme. And in both examples, I'm going to look at a retirement age of 60. It's important to remember that you don't need to retire from both parts of the scheme at 60. Usual retirement age for the 1995 scheme is 60. The retirement age for the 2015 scheme is somewhere between 67 and 68 for most members. There is no compunction to draw benefits from both at the same time. So for the examples I have, but it isn't necessarily the case. So example one for a member who's currently 45. Within the 1995 scheme, the total charge paid by the scheme to HMRC is £10,678. That's divided by a factor of 17.3. Now, these factors do change depending upon the age at the point of election and the age at the point of retirement. That makes an immediate reduction in the NHS pension of £617. That's the initial certain reduction in benefits that scheme pays as generated. That is increased each year by this factor of CPI plus 2.4%. Now, I've deliberately ignored CPI in these calculations for two reasons. Number one, we simply don't know what it will be. Number two, because your pension goes up by CPI and the effect of the scheme pays election goes up by CPI, by ignoring that figure, we get a true reflection of what scheme pays costs. So £617 times 14 years of 2.4% compound interest increases that pension reduction by £860. Because that's also in the 1995 scheme, that also reduces the lump sum payable by 3 times that, so by 2,580. Principle in the 2015 scheme is the same. The factors differ. It uses a lower factor, so the factor is 12.4. Immediate reduction on pension of £1,011, which once we've compounded that up is about £1,400 at 60. That means for a 45-year-old member with that £23,000 election, the pension is reduced, ignoring CPI, by about £2,260 per annum, and the lump sum by £2,580. Now, in all these examples, spouse and dependents benefits are entirely unaffected. Moving on to the next example, I'm using exactly the same figures, but for a member who's 55, so only 5 years from retirement. The factors differ. So once again, you've got that £10,678 cost. The factor changes to 21.7. There's only 4 years worth of interest to add on to this. And remember, it's 4 years rather than 5 because interest is charged 12 months after the election. Which makes a reduction of £541 and £1,623 on the lump sum. Similar equation with the 2015 scheme. The factor used is more generous, so the total reduction is less. So for a 55-year-old member, the total pension reduction is £1,413 and the lump sum by £1,600. So if we move on, you can see from here that whilst it isn't fair, it is certainly true that scheme pays elections are cheaper the older you are. In the examples I've just used, the pension is reduced by £856 less for the older member and the lump sum by almost £1,000 less. So there's a 38% difference in cost in using a scheme pays election, and that works both ways. If you're older than 55, it gets cheaper and cheaper. If you're younger than 45, it gets more and more expensive. Two important things to remember: those examples have ignored CPI. Also, it isn't possible at the point of election to accurately calculate the eventual cost, as I said, because A, we don't know what inflation will be. Secondly, the NHS scheme has, I think, 3 times since the scheme pays election has been available, has reduced the interest rate they charged. I said it started off at 3.1% over CPI, it's now reduced. So if we can move on and have a look at how those scheme pays elections interact with the lifetime allowance. I think it's fair to say that most full-time partners will end up with a lifetime allowance if you have a sort of a fairly normal career. Now, as a reminder, the lifetime allowance is a limit to the total amount of pension benefits you can accrue during your lifetime. Now, this is only charged at retirement, so it's not anything to worry about like the annual allowances at the moment. The lifetime allowance, if you currently have no form of protections in place, is £1,073,100. It was £1 million 2-3 tax years ago. It's gone up subsequently by inflation. Unfortunately, this is one of the allowances which has now been frozen for the next 4 tax years, so it's going to stay at that figure for some time. That's assuming you have no form of protection in place. Each time the allowance has changed, HMRC has put in place certain protections which has allowed people to fix in higher lifetime figures. The only one currently available, if you don't already have some form of protection, is what's called IP16, so Individual Protection 2016. This is available for anyone that had already exceeded the lifetime allowance as of the 31st of March 2016. So we're looking at sort of 5 years ago now. If you feel you were in that situation, then you should take advice. You can apply at any time, but it would make sense to apply sooner rather than later. So what does that mean in real terms, in NHS pension terms? Assuming you have pensions from no other sources, that £1,073,000 equates to a pension in the 1995 scheme of about 46,600, in the 2015 scheme of 53,600. Now, by definition, you will have some membership in each, and depending upon individual circumstances, your actual figure will be somewhere in the middle, but it provides some guidance. So if we move across to the next slide, as Louise said earlier, there is obviously a tax liability with exceeding the lifetime allowance, but there is also a benefit in using the scheme pays election. So lifetime allowance charge is 25% of any pension that exceeds the current allowance. So every £100,000 you've exceeded the lifetime allowance by leads to a tax charge of 25%. Unlike the annual allowance, this has to be paid by the scheme. There is no opportunity to pay this directly as a member. It's a liability on the scheme itself. As with other parts of the scheme, when there's a tax charge, they recoup that by reducing your pension. They use a different factor, which once again differs on age, but if you retire at 60 from the 1995 pension scheme, whatever the tax charge is divided by 20.6, and that's the annual reduction on your pension. So in this instance, about £1,200, which is quite a useful figure, because as a rule of thumb, every £100,000 you are over the allowance reduces your pension by £100 per month at retirement. You'll almost certainly be higher rate taxpayers at retirement, so that's a net loss of about £60. So how does that interact with the scheme pays? Well, the lifetime allowance is charged on the pension you physically receive. Now, the scheme pays election obviously reduces your eventual pension benefits. That reduces the value of the pension fund, and that reduces the lifetime allowance charge. So if you've got a scheme pays election of £3,000 at retirement. That reduces the pension fund by a total of £69,000 within the 1995 scheme. It's slightly different in the 2015 scheme. That reduces the lifetime allowance tax charge by £17,250. That reduces the reduction in your pension by £837. What it means practically, although this is outside of the remit of giving an advice in a presentation such as this, it is unlikely that if you have a lifetime allowance charge that it would be sensible to pay your annual allowance charge directly. By doing so, you're maintaining the integrity of your pension fund, but all that potentially means is that you end up with a larger lifetime allowance charge somewhere down the road. So if you've got a lifetime allowance issue, it's almost certainly sensible to use scheme pays. So if after all of that, the election is to leave the scheme, what actually are the impacts? So the first one is those death in service benefits are lost. So those twice average earnings are lost as soon as you leave the scheme. That's even if you leave the scheme for half a scheme year, you don't receive those benefits for the period you're out. Now that in isolation shouldn't be a reason for most people to decide to stay in, unless you have severe ill health, in which case it's a different conversation. But assuming good health, if you were looking to replace that life cover just on a personal basis, just with a life insurance policy, £200,000 worth of cover, which would pay out for 15 years for a 45-year-old, costs about £24 a month. That's assuming you're a non-smoker and you're in reasonable health. That same cover for a 55-year-old looking to cover for 5 years is about £41 per month. So it is possible quite easily and relatively cheaply to replace those life cover benefits. Other benefits that are lost, as Lizzie referred to, if you're out of the scheme for a whole year, then you lose the, your pension continues to increase by CPI, but you do lose the additional 1.5% uplift. However, that can aggregate back into your pension if and when you rejoin, normally within 5 years. I don't think anybody is listening this evening is likely to have final salary pension benefits that be accrued if you've had worked as a consultant or worked in a hospital for a long period of time. But if you do have final salary benefits as well as practitioner benefits, if you're out of the scheme for a full 5 years, you lose the link to the final salary. Ill health benefits, those tier 1, tier 2 benefits are retained. However, they can become more difficult to claim. That's purely based upon a slightly different definition used for deferred members. Spouse and dependents benefits are also retained. However, as with all the benefits, if you're out of the scheme for a protracted period of time, then they begin to erode in true value. If you're out of the scheme for many, many years, obviously you're not accruing pension benefits, you're not accruing spouse dependents benefits, and that's why it's very important if you intend to leave and not rejoin to take financial advice and actually ascertain and make sure you've got suitable protection and arrangements elsewhere. So what could be done with other benefit? What could be done if you do choose to leave the scheme? Now, obviously, pensions are out for the member because you'll have left the scheme because you've got lifetime or annual allowance charges. And if you make private pension contributions, it causes exactly the same problems. I do see many clients that have lower earning spouses that have access to potentially quite large pension payments. You can pay up to 100% of a spouse's earnings into a private pension each year, subject to this maximum of £40,000. So it is possible to fund quite significantly a spouse pension in certain circumstances. That obviously doesn't work if you both have lifetime or annual allowance issues. If you've got a non-earning spouse, you can still pension to a far smaller degree, £3,600 per annum. That's under the stakeholder rules. That's the same sets of rules which allows you to pay pension payments for your children. More broadly, it is important at retirement to ensure that both partners, if you're married, have reasonable level of incomes. So it's important to try and equalize incomes as far as possible. There's no point in having one partner earning £80,000 and having £30,000 worth of higher rate tax liability and another spouse earning little or nothing and not even using their basic rate. So part of planning is trying to look at what the situation is post-retirement. ISAs are the next obvious port of call. They don't receive any tax relief like pensions. However, they grow in a tax-free environment and you can draw back out of them tax-free. Of increasing interest to many members that have got issues with pension tax charges, which is causing them not to fund any further, is venture capital trusts. They are higher risk investments, but have become increasingly mainstream. You can invest from £5,000 as a single payment. As long as you keep that payment in for 5 years, you receive 30% tax relief up front. As with all investments where government provides some sort of incentive, there's a reason they provide that incentive. In this instance, it's because they're slightly higher risk investments. And I would only take them after receiving advice and getting a full evaluation of what the risks are involved. But I said they can be built into most people's investment plans. That is something of a whistle-stop tour. There's my contact details if you've got any further questions. I think we might have overrun slightly, but I think we still have a few minutes for questions.
Thanks, Simon. I have been going through, well, Lizzie and I have both been going through the questions and answering some, because conscious that we were running out of time. So hopefully you'll have got a notification if you've asked a question, but I'll pick up a couple of the other ones that I haven't got round to answering as of yet. There was one that was raised, I'm not entirely sure on what they're referring to, and it says, what happens to doctors with lower than 3,000 in the 95 scheme? I'm not sure where the 3,000 comes from, so it may be that if you want to message us separately or ask the question, we can come back to you at a later point on that one.
I suppose he may mean, Louise, that there's just a small amount of benefits maybe in the 95 scheme, which obviously means you're not going to get as big an impact of the inflation, because 10.5% of 3 grand is less than 10.5% of 30 grand. But we can't give a specific answer, because it depends on how much you are earning and how much your taxable income is as to whether you'll be tapered. So yes, it could still be a problem, but as with all these things, it will come down to your own individual circumstances on earnings, how long you've been in the pension scheme for, etc.
Yeah, absolutely. So the next question, if you leave the NHS and move abroad for a few years, do you have access to the accrued 40,000 allowance when you return? I think you do. I think you do. I did a bit of Googling while Lizzie and Simon were talking. I'm not 100%, but one thing I did find was that if you are a registered member of a UK pension scheme, and by registered member that could be active or deferred, I understand you do still accrue a 40,000 allowance, but I might have to just take that away and double check, unless Simon, you know the answer?
No, I was going to hope you weren't going to ask me.
I think you do, but I'm not 100% sure. Not had anyone in that situation, but I think we have people's contact details, so we will go away, find an answer and come back to you in that respect. Okay, just moving through some of the other ones that we down the bottom that I haven't got to just yet. So Simon, I think this might be one for you. It says it's only up to what you accrued so far on tier 1 and tier 2 health benefit.
So with regard to health benefits on tier 1, if you have tier 1 ill health retirement pension, you can receive early whatever pension you've already accrued. So just whatever the TRS statement says, it just pays it early without any penalty for being below 60. Under tier 2, you get that, plus you get an enhancement of 50% of a notional pension that you would have accrued to normal retirement. So if for ease you're 50, when you get a tier 2 ill health retirement, you'd receive everything you'd accrued up until age 50, then you'd get 50% of the notional amount you would have accrued for the next 17 years to the scheme retirement age of 67.
Thank you. Well, the next question, the person's just left, so I will follow up with that one separately. At what age does the 95 scheme start? So it would be based on when you started contributing to the pension scheme. So if you started contributing, obviously after 1995 and before 2008, you would have gone into the 1995 scheme. when the 2008 scheme came in, you would have had the option as to whether you transitioned to the 2008 scheme or not. Depending, it's not about age, it's about when you started contributing to the pension scheme and whether you transitioned to 2008 when you were given the choice or not.
We would always recommend that in addition to maybe downloading your total award statement, that you contact the pensions agency for a membership record, which will show all your when you joined the pension scheme, so that will confirm which scheme you're in to start with, what your pre-practitioner service was, whether it's whole-time, full-time, at what hospitals, and when you became a practitioner, just to check that it's correct and there's no gaps in your service, because we do see a number of gaps in service where hospitals haven't updated records. It's not always easy or possible to reinstate those gaps. Don't throw away any payslips is always the answer. I think is it called an SM27C form, Louise?
SM27A, I think. I think it might be an A. Lizzie, can you just flick back to the slides with the contact details on, because Simon, someone has asked for Simon's email address, so there we go. There
was a question on there about McLeod.
Yes.
Where are we with that? The Pensions Agency and all public service schemes have until October 2023 to update the records, update the pensions to show the revised 95 benefits under the remedy and issue any revised annual allowance figures. I suspect it will not be sooner than October 2023, but unless Simon knows anything else, I think there is a concern it may be slightly later, but it's not going to be sooner, I don't think.
No, I don't think there are. I'm conscious we are 12 minutes over and everyone probably has an evening that they'd like to get back to. There are a few questions on here that we haven't answered, but as I said, we have contact details, we have a note of the questions, so we will come back to you with answers to any questions that we haven't yet covered off. So thank you, Lizzie. Thank you, Simon. Hope it has been useful. We could always talk about this for hours, but any questions, please do get in touch with Lizzie, myself, with Simon, with your usual Larking Gowen contact if you have one. But otherwise, thank you very much and have a lovely evening.